not only are valuations stretched, they are categorically at all-time highs on the metrics that are most reliable with future predictive returns. That is a black and white categorical statement we can make without anybody's opinion affecting that statement. It's reality. Okay. So being okay with selling down from 80 to 40 or 30% and it not being the absolute high, that's okay. The worst sin and the worst regret that one may have to deal with is not doing that and having a massive reset in their financial security, one that literally may be forcing decisions like, hey, I thought I was going to retire 2 years from now. Now I got to work another seven.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for another monthly review with the team at New Harbor, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners John Lodra and Mike Preston. Hey guys, how you doing today?
Hi, Adam. Great to be with you. Thanks for having us.
Hello, Adam. Good to see you again.
Thanks, Mike. And hey, thanks again, particularly to you, Mike, and Justin there at New Harbor for hanging with us all day long at the Thoughtful Money Fall Online Conference a week ago. It was a great event, but great in part as well. You guys making yourselves available there and answering folks' questions in the live chat and all that. Look, lots even happened since that conference. Now, the day we're recording here, and again, we usually have you guys on every week. Usually you're reacting to somebody's video and we talk a little bit about what the markets have done over the past week. But we have started this new routine with you guys. I think we've been doing it 3 or 4 months now, where we have you on and you give your own hour in terms of your full outlook and any changes you're making in your portfolio and what you think might lie in the road ahead. So lots to react to here. One thing we're not going to be able to react to too much is the Fed meeting, this week's Fed meeting, because the news, the actual official release from the FOMC is going to come out about an hour after we finish recording here. So we'll find that out. But I really don't think it's going to be too much of a surprise this week. It seems very clear that the Fed is going to cut by 25 basis points. They will likely announce the end of QT. If they do anything terribly different than either of those two things, then yeah, that probably will surprise the market. And if so, we'll talk about it with you guys next week. That being said, John, why don't we start with you? Love to hear any other thoughts you might have about this week's Fed announcement. But more importantly, I know you had pulled some charts together and charts of the Fed balance sheet and a few other things going on. But it looks like, because the Fed has pivoted and is now going back to cutting and maybe ending QT, it's not because it's mission accomplished per se. It's because, hey, there's some real concerns going on. Now, the Fed has talked about weakness in the jobs market, but I think you're beginning to see some initial signs of stress in the credit markets, which of course we know that's where really all the chips are. That's where the big money lies. So what are you seeing right now?
Yeah, thank you, Adam. And we will indeed, by the time this video airs, we will indeed have the Fed announcement and post announcement press conference. So we'll learn more about their current thinking. But it's all but certain, at least the market thinks so, that the Fed will drop 25 basis points, 1/4% on the short-term federal funds reserve rate. And again, this affects very short-term rates. It doesn't affect in and of itself things like mortgage rates and things like that. That's more as relates to QT, and we'll talk about that in a second. But the market is all but certain that the Fed will drop 1/4% today. There has been some talk about the Fed starting to reach a point to end the quantitative tightening program that they restarted, I guess, back in 2023, I guess it was. And just to put that, you talked about, the whole idea of mission accomplished. Let's look at a picture here to kind of put that in perspective, because I think it's really just eye-popping where we've come from and where we are. This is a chart. It shows the total assets on the Federal Reserve balance sheet. And basically, just a reminder, when the Fed, in the wake of 08, 09 financial crisis, they entered several rounds of quantitative easing, QE1, 2, 3. And basically what quantitative easing involves is the Fed printing money literally out of thin air, paper dollars, base money supply, to go out and buy bonds, treasury bonds, mortgage securities, and those bonds end up on the Fed balance sheet. So in the 100 years, nearly 100 years of the Fed's existence prior to the GFC, they amassed a balance sheet of about 900 billion. And then you can see what's happened since then, right? We've had QE1, QE2, QE3, and then QE4, you might call it, in the wake of COVID. Here we are today in October 2025. The Fed's balance sheet is still just a tad bit below $7 trillion. Again, I'll remind folks, before the great financial crisis, it wasn't even $1 trillion, not even close. And back around here, I forget the actual date, but it was around in 2010. I can remember it like yesterday. Ben Bernanke made a rare appearance on 60 Minutes. At the time, Fed chairs didn't do these kinds of things. They didn't go on 60 Minutes and, give up the ghost in terms of what their thoughts were. He basically, to paraphrase, said, "Hey, these are temporary measures. We're going to be able to reverse these measures, not too far down the road once the economy stabilizes." And here we are today. And look, we haven't reversed those measures. We've had, some normalization in the balance sheet. And what this quantitative tightening is basically the Fed hasn't sold these bonds. They've just, as these bonds have matured, they simply haven't reinvested the proceeds. So they've, taken liquidity out of the system in that way. But we still are way, way higher than we ever were prior to the GFC. And we're at all-time highs in the stock market. We have, still relatively healthy economy. I know there's emerging cracks in employment and things like that. But to think, if anybody was asked back here, would we still be at nearly $7 trillion and talking about an end of QT? I think people would have lied through their teeth saying that, yeah, that's going to happen. So just a dramatic thing. And why is this happening? Let's take a look at some other data points. We're starting to see some stress in the system. This is a chart that shows some key spreads on some key interest rates. And I don't want to get into the weeds here. These are kind of technical things, but the one I want to highlight here is what's called this secured overnight financing rate. This is the rate that banks can borrow collateralized by their treasury holdings. And typically when that starts to blow out relative to this thing we call interest on overnight reserves, that's a sign of some liquidity crunches, some balance sheet concerns, some credit concerns. And we've seen in recent weeks some defaults and stresses with some of the subprime auto lenders and other kind of non-bank financial institutions. I think the word cockroaches has been used. Jamie Dimon talked about, where there are some cockroaches, there probably are more. We're starting to see that in some of the data. And all these interest rate spreads are starting to spike up here pretty notably at a time when the red line is the total amount of reserves in the system. Those have pulled back. These are overnight reserves to $3 trillion. That's on the x-axis. So it's evident that whatever liquidity has been drained from the system is starting to exacerbate some fragilities in the system. And so I think there's a bit of a credit panicking here. And I'll just finalize with this chart. This is the what's called the overnight repurchase activity. This is basically when the Fed right here stopped temporarily their first round of quantitative tightening. It was in response. I'm sorry, right here. It was in response to the repo market blowing out, and that's ultimately what led to, just before the COVID, no linkage there, but so much for their attempts to tighten the balance sheet at that point. The repo market freaked out in 2019. Quietly, the Fed had to come and save it, and we're starting to see some murmurs there. I don't want to over exaggerate what we're seeing here, because oftentimes there is some activity near month's end, but it connects some dots as to why the Fed is suddenly becoming much more dovish in terms of not just rate drops, but also ending QT. We'll learn more when the Fed comes out later today, but some very emerging kind of concerning things that we want to be watching very closely.
Okay. Mike, I want to connect this with a few things that we were talking about before we turned on the camera here. So I think you've got a stat that says that that we've hit a point now where the top 10 companies in the S&P 500 now make up 40% of the indice's value. right? So the day we're talking, the stock market is at a new all-time high. We are less than 100 points away from the big S&P 7,000 milestone. So, John is pointing rightly to, some signs of stress, some signs of concern, but the market just does not seem to care, right? I think just yesterday, Nvidia became the world's first $5 trillion company. I think Microsoft just passed 4 trillion. As I like to say, yeah, now if you take Nvidia, Microsoft, and Thoughtful Money combined, those three companies are worth $9 trillion.
Thoughtful money being the biggest one out of them, right?
So, but yeah, so just react to the contrast there between what John is noting at is, hey, the Fed is kind of being forced to pivot here by weakness in the job market and maybe some other things. We're seeing some signs of stress looking at, even a lot of the Fed's own metrics there that John showed. We've got some cockroaches that people are starting to notice. Square that with stocks at all-time highs and nobody really having any worries on Wall Street, it seems.
Adam, I think it's going to sound like a simple answer, but it's all about liquidity. It's just been liquidity and nothing but liquidity for many years. And some of your guests talk about liquidity in particular. I can't remember the name of the guest that does that so often on your channel, but
Michael Howe.
exactly. Yeah, he talks about it, and it's been that way for many years. So it's no surprise that things that are really exaggerated get even more exaggerated. And you're right, the top 10 companies are 40% of the S&P. And so, yes, and out of those top 10, five of them are reporting in the next 2 days. We got Meta, Microsoft, Google, Amazon, and Apple. A couple of them tonight. I think it might be Meta and Microsoft tonight. Tomorrow, Google, Amazon, Apple. But it doesn't matter exactly which day. It's in the next 2 days. These five behemoths, and it is just the huge gorilla, as we often say. Another one of your guests calls. I can't remember the name of that guest either, but it's like the huge 800-pound gorilla is the liquidity and these big companies that are in this market. And so it doesn't make sense because we are seeing some signs of stress. The unemployment numbers, which are, by the way, good for small and mid cap companies, and so maybe that's why they've been doing a little bit better. But the Fed is probably behind the curve. A number of people, a number of your guests have said that they're probably behind the curve. We'll see. They'll probably panic when we get a big drop in the market. Now, what's going to cause a drop in the market? Who knows? But this market is dangerous because it's so thin. If you take a look at Nvidia, which you just said is the first $5 trillion company, it's just been straight up the last couple of days, including today, right? And so the biggest companies are moving the most. Microsoft almost hit a new all-time high, and they're reporting, I think, tonight. And that might happen on the earnings report. So let's see what happens with the earnings reports. But other things like financials are lagging a little bit the last few weeks here. Equal weighted, S&P is lagging a little bit. Russell 2000 is lagging a little bit in the very short term. All of that can change very quickly, but if you just look at the charts over the last few weeks, you'll see that on these big up days, the Nasdaq's up big, the S&P's up big. Equal weighted S&P is not participating. Russell 2000 is not participating as much. Now, does that have us really worried? Not too worried yet. But take a look. Let me just mention one or two things about our own system, our own indicators. Our own indicators are mixed and whippy is probably the best way to put it, with a slight lean to the bullish side. A number of our indicators look at relative strength readings, short-term moving averages, even chart patterns, things like that. Leans a little bit bullish. That's why we don't have index puts on or index hedges on our model right now. That could change, but that's how it looks right now. But the real short-term stuff is whippy and mixed. Like I said, financials, et cetera, are lagging a little bit in the last couple of weeks, and so we have to see what happens here. We're knocking on the door of 7,000 S&P, as you say, and if we get there, we could catapult higher, and everything could start participating, and that would be the kind of everything all in parabolic melt up type moment. I think we're already in that type of blow off top moment, but it could get even more exaggerated. And if that happens, if we're lucky enough to see that, we will take action, probably selling into that rally a little bit at a time versus getting more committed. So we're at risk here now of this vertical blow off. I wouldn't bet on it and I wouldn't trade from this perspective. But with a mixed bag of indicators, if we break through some of these resistance levels and it's an everyone in the pool type moment, it could give us the signals we're looking for. Like I think I've mentioned before, if you see something like 500 S&P points up in a couple weeks, then you're getting close.
Okay, I was going to ask you to repeat that for folks, so I'm glad you did. All right, so in the interim, I hate to use this analogy, but the music is still playing, and to a certain extent, you guys are still on the dance floor. You've got what, 45% equity exposure in your portfolio?
Yeah, 45%, if you don't count gold mining stocks, which we don't really. That's separate. But 45% equity, yes.
Okay, all right. I'll get in a moment to any potential portfolio changes you've made recently, but just to kind of give the punchline up front, are you making any big changes right now, or are you still sort of executing on the allocations you've largely had of late?
We're not making any big changes. Over the last couple of weeks, our indicators were leaning more bearish. Nothing's been really definitive. But in the last couple of weeks, before this week, indicators were leaning more bearish. So we wrote some calls, sold some short calls on some of our positions, like emerging markets and a few others. And selling calls brings in some cash, and it's a slight or a partial hedge. If we saw further deterioration, we would either start taking stops in our underlying positions or add index put protection. But that didn't happen. We've now shifted, as I said, more towards the bullish side without conviction and confirmation. So we covered one of those. Well, actually, it was on the gold miners. We covered one of the short options. We did not add any more here because we're leaning bullish. We're not adding index puts because we're leaning bullish. So the only thing we really did is we added a few short options. A few weeks ago, I think we already mentioned this. We added oil service stocks, and those have started to take off in the last couple of weeks, which has been nice to see. But that's not new. So really, we're sitting here at 45%. I think they answer another part of your question. I don't really see us going up from there, even if we get this melt up. It's more like we're happy with the participation we have in other areas, including long-term bonds, which are looking better, and gold mining stocks and silver, which have obviously been a really great performer this year. It's more like we would sell a little bit into some kind of melt up, or if we get the opposite, a meltdown, we'd probably be taking stops and reducing from there. So we're probably roughly at our maximum equity exposure here, almost no matter what happens.
Okay. John, I'm going to come back to you just a minute, but Mike, let's stick with you for a bit. Because I know one of the most frequent questions you guys must be getting right now, because I'm getting it a lot, is, all right, gold, is the top in? Is the party over? And probably paired with that is this going to be a repeat of like what we saw back in, when was it, 2012? When stocks, gold and silver prices peaked and then, basically kind of gave up most of their gains and then were dead money for a decade.
And that was a long base, wasn't it? We've often shared the long cup and handle chart on the monthly chart of gold. It did peak in 2011. It took almost 10 years to come back. And once it did come back and break out from that level, at almost $2,000 an ounce, it had a quick doubling over less than the next year. So gold has been on a big tear. And while nobody knows the future, I think this time is different than 2011. Back then, they had gold buying parties in people's homes. And there was all kinds of advertisements for cash for gold and that type of thing. And I just think we're further along in this debasement trade story. We're further along in history, in the cycle of things. And we're entering the last 3 to 5 years of a fourth turning. All of which tell me that this time is different. And again, nobody can know for sure, but I believe it's different this time. Famous last words, right? Write those down.
Mm-hmm.
But having said all of that, the trade got extremely overheated. And we can just tell from the psychology of it. A number of clients and non-clients that we talked to wanted to be all in that market, in silver and gold and miners. And there was just a lot of overconfidence, and we were seeing just day after day after day straight up. And so we were warning people to think about selling a little bit on the way up because psychologically it becomes a trap. These days, we're talking to people over the last few weeks about this psychological trap of being all in something. Not everyone is all in. In our model, we're only about 12.5% between miners and silver, monetary metals. But some people are 50, 80, 100% in, and they just, once you're all in, it's hard to get out at all. So we've been coaching people to sell a little bit. I had a call today with somebody like that, that was nearly, well over 50% in metals. And we were talking about how it makes sense to sell 10% right here. You sell 10% right here and use that money in your life. A lot of times people have trouble selling anything with gold and silver because of that all-in viewpoint and because they don't know what to do with the money. I would say nearly 100% of the time when I talk to people about selling into a rally, which is how you want to do it, they always say, well, what am I going to do with the money? Because they don't believe in dollars and they can't get unstuck with that. So I found it's a lot easier to talk to people about doing real things with the money, like take a trip, do a home improvement construction project, help the kids, whatever. But I find that it helps people take the money, get permission to do it, and then do something interesting or fun with it in their real life. And so that's kind of the whole psychology of it. The math of it is this, and if I could just share a chart or two, we can talk about the math or what happened in the charts. All right, so here's silver. This is going to be the silver ETF coming up. We walked along the outside of the Bollinger Band. We had a big breakout back here at around 32 to 33 on this ETF, which was 35 silver. We talked about that triple top numerous times on this program. And since then, we've walked up in the next 4 months. This is a big, big move. And so this got really overheated. Now look at this pullback. This pullback is nearly 20%. It's like 18% in silver.
Yeah, that's painful if you bought right there at 49.25.
It's painful, but let me back out to the weekly chart. Now here's the weekly chart, and here's the triple top breakout that I just mentioned. All we did is came back to the outside of the weekly Bollinger Bands. I've talked a little bit about the 5-week EMA or exponential moving average. This happens to be the 21. But Sven Henrik talks a lot about the 5, which is why we were bringing it up here. He was on your program a few weeks ago talking about it. Yeah, we basically came down to the 5-week moving average and shot through it. But if you take a look here, we're right back to it. So this pullback of about 18% was mirrored roughly in gold as well. Take a look at gold on the ETF, went from 403 to 360 something, pretty darn close to 20%. And if you look at GDX, it had a 20% pullback. This is painful for people. As nice as this felt, this pullback is fast, right? And we've already had a pretty good bounce. So let me go to the daily. Change this daily back to the 21 period moving average. We can take a look at that.
Before you get to the bounce, I just want to take a moment to note that while it wasn't super popular at the time, because everybody was loving the daily great gains, and saying, no, you guys don't get it. This is the great repricing of gold and silver. It's underway. It's not going to stop. We were counseling that people consider hedging in some way, shape, or form, whether it was selling a little bit, as you said earlier, Mike, whether it was just putting on some downward hedges. And this is exactly why. Now, some people might say, well, look, I'm not going to sell my gold and silver, and I think it's going to continue to go higher from here in the mid to long run. And I agree with them. And yeah, if you want to, you could just ride that down and then hopefully ride it back up. But of course, we don't know how long it's going to take to recover. Hopefully, it won't be that long, but it still could go lower, and it could stay down longer than we'd all like. We just don't know yet. But also, too, if you put some hedges in up there in the stratosphere before this thing corrected, well, now you're sitting on some gains on those hedges, and you've got some dry capital to start dollar cost averaging back in if you want to increase your exposure. So I just want to, now that this has happened, I just want to really explain to people why we were being so persistent and saying, hey, you really should think about hedging.
Yeah, well, that is the big question, Adam, is was this the top? I don't think so, but it was very overheated. And we were hedging on the way up, and I'll be honest, we were early. We had some short calls down here at 63. I'll put a line there. And then those got buried. Then we had this crazy blow off all the way up here. We had a second layer of calls at 85. So we had these two, about half of this hedge down at 63, the other half up here. Well, we got this pullback, and guess what? The first thing we did is we moved this hedge up, and we've got some premium for doing this. So these are not the called returns, but we moved the 63 up to 67, I believe. So that first one is gone. We were able to move that hedge up. That one is in the money, but you have to add in accumulated credits to understand what that sale price would be. Bottom line is we got a really good, really robust hedge on that half down here. And when this pullback happened, we covered this 85 hedge for nearly a full profit, which adds cash to the account and hedges the position. So now we have half hedge down at here, and we've got full participation if we get a bounce right back up towards the top. This is a pretty steep downtrend. My guess is that we'll probably chop around here for a while, ultimately break base out and break higher. Again, far from guaranteed, which is why we always talk about be careful being all in anything. But I do believe gold and silver are signaling that this is the real deal in terms of getting closer to the end of this whole debasement story. Central banks haven't stopped buying gold, and probably won't. And I really do believe gold and silver will go higher. We don't have to have it be that way. If we're wrong and that was the top, well, we've got it pretty well hedged, and we'll start taking stops on the position at some point. So, but right now, that's how we're managing it. And I can't stress enough, sell a little bit into it up market. Um, and you can really just tell by your level of discomfort. If you're having a lot of discomfort over this, you're probably a little heavy. Talk to us. We can help you get a little bit unstuck. You know, when you go to John a little bit later, he may want to share some of the charts about how extreme things were from on a math sense. In a math sense, I just shared some thoughts from a psychological and a chart perspective. The trade was way overheated. Is it done? Probably not, but we never know for sure, which is why we have our hedges.
Okay. And Mike, so you guys have been doing some pretty proactive hedging here, as you just walked us through. Your core positions, are they different at all today than where they were a couple of weeks ago, or are they largely unchanged and your action's been around the hedges?
The core positions in our other sectors you're talking about, I think, right?
No, I'm talking about precious metals and precious metals miners.
Yeah, our core position isn't different. Our core position has been roughly 10% model weight miners and 2.5% silver. I didn't talk about our silver hedging there, but we did something similar in silver. As it went vertical, we sold calls. It went even further, went into the money, and then had the big pullback. On the big pullback, we moved our hedges up so that our floor is higher. So that part hasn't changed. We did notice, and we don't know if it's whippiness yet. As I mentioned, our indicators are whippy, but relative strength has now favored gold bullion versus gold miners. It has been gold miners for the longest time. And it's simple. If you just look at the monthly or daily or the monthly, daily, weekly, or monthly performance of miners versus bullion or vice versa, you can just chart these things out. And it's now flipped back in favor of bullion. It's impossible to tell whether that's a whippy indicator that will reverse quickly or if that's durable. So that's something we're keeping our eye on. If that sticks, we'll probably start to increase our bullion position relative to the mining position. But no, our core, we're dancing around the core here, really. Our core position hasn't changed.
Okay, and that's what I wanted folks to take away from it. It wasn't like because of the recent action and the recent correction, it's not like you materially sold out your position or anything like that.
No, no. That would happen on a breakdown, hopefully from much higher levels, hopefully a long time down the road. It's tempting to say, well, shoot, this was a moonshot. It's all done for gold and silver, but real big bull markets in metals and in frankly any sector will try to shake you out at least once. And I've said before that in real big bull markets, you'll see a double off the bottom or double off the base and then a double again. Silver miners, gold miners, they have a little more than doubled in general off their base. And now we have this big pullback. Is this really the first pullback to throw people off the bull? I think so, though we're not betting on it, but I think that's likely. And I think we might likely see another doubling from these levels in some of these things. I don't know if we'll see that in the majors, but in some of the smaller companies and the silver miners, I think they could easily double again from here. So again, this is not a recommendation to go in. It's just talk to us about your individual situation if you'd like. I just don't think it's done yet. But if it is done, Yeah, that's the thing. This is what a professional does. They have a plan in place for what to do. Our signals will continue to give us negative signals. If that's the case, we would probably start to ease out of the position, maybe with that half that we have hedged. But right now, the jury's out. Let's see if we get a further bounce from here. And I'm thinking that we might.
All right. Well, now, John, let's come over to you. Thanks for being patient. John mentioned some of the charts you have, which, I think build on this conversation he and I were just having in terms of the kind of extremes that we were at, and then what tends to happen after these extremes.
Yeah, I think it would be important to share some of these only because these are inherently emotional decisions, and we always bring things back to the data to help us kind of ground ourselves. So let me share a couple of charts that they actually were pulled together by other folks, but they resemble some of the internal dashboards we look at that are just frankly more friendly to share for your audience here than our dashboard. Our dashboard is a little bit wonky for our internal purposes. But this is a chart that looks at both gold and silver. And this is as of 2 weeks ago, essentially, roughly about 2 weeks ago, right when both gold and silver were reaching their recent peaks. And, for example, we looked at gold had only been up 9 weeks in a row, a handful of times in history, 5 times essentially, including this most recent instance. Never before in this long history, going back to the 70s, had gold been up 10 weeks in a row. And you can see the follow through performance in these instances. Almost every very low probability of follow through positive performance going out a day to 2 months later. In fact, not only not positive, but there's some pretty big historical precedent for some big pullbacks. Not unlike what we've seen. So we were very much as bullish as we have been and still remain longer term precious metals. We thought there was a very high probability of a pullback. In fact, that's happened, and that's why we had the hedges we had in place. Same thing with silver. You can see this is a different look, but it's basically the relative strength had got so extreme, exceeding 86, and just a number of extreme relative strength that again, almost every time in the very small handful of instances in history this has happened, the follow through for weeks to a year later were almost categorically negative. Contrast that with this is just from yesterday, and it shows in similar historical instances where gold or silver has pulled back as massively and as quickly as it has this time, almost without fail, the follow through anywhere from a day to a couple months later in case of gold, and a day to a year later, more often than not, the follow through has been positive. This is not a guarantee. Every time is different, and we're not huge fans of averages. But these charts just show I think, a picture the extremity that we had reached and the very high probability that that translates into a pullback. And now that we've had that pullback, the coast is clearer. It's not a perfectly convincing case that we go higher here. Mike mentioned, and this is probably a pretty good base case, that we may gyrate sideways here a bit. Might be a little bit volatile, and we're happy to have some hedges still in place, even though we use this pullback to modestly increase our position after effectively having sold some in that rally by virtue of the hedges we had. So just wanted to add that context to the whole dilemma of how much to sell, when to be patient and step to the sidelines. And that's every bit of conversation that's still relevant for a lot of people here today. Not just with precious metals, but we talked about NVIDIA and some of these high-flying stocks. These are all the same kinds of discussion. What is your position size? What are the probabilities that we see continued trajectory that we've seen? I mean, NVIDIA probably is going higher at some point, but is going to keep the same pace of ascension that we've seen recently.
All right, Mike, John, thanks so much, and appreciate you guys both going so deep into the precious metals there, because that's been such an acute topic right now that folks have been looking for some insight on. So I think you guys did a great job. John, to another asset class that is sort of on the move right now, and again, one that folks kind of are asking questions about, is bonds. So we are now seeing the Fed, going into a cutting regime. And so if you've been sitting there in the T-bill and chill trade, you're starting to see your T-bill yields start to go down. And now we have just recently begun to see the 10-year fall below 4%. and looking like it's potentially going to keep going down for at least some period of time. What are your thoughts there on bonds right now?
Yeah, so let's share a chart of the 10-year yield. This is a chart of the 10-year Treasury yield. These numbers are off a decimal place. So, for example, right now we're at 3.99 nine on the 10-year yield. I'm sure a lot of this, it's been a pretty boring day today in the bond markets because all eyes are and ears are waiting for the Fed. But there is an unmistakable downtrend in yields since about May in these bond yields. We had this huge panic in the bond market back on Liberation Day. It seems like years ago, but it was just a handful of months ago. That was a huge scare in the bond market, and it caused a lot of policy changes and change in tone from the administration as to what their policies would be. But we've seen a pretty consistent and trending declining yields. And right now, the path of least resistance is probably for yields to continue to drip lower, especially if, for example, the Fed comes out more forcefully and talks about the end of quantitative tightening. Essentially, what that does is it basically creates less supply in the bond market, and all else being equal, less supply relative to the fixed demand. You're going to see those yields come down and prices go up. That's the likely scenario. If we look out a little further to longer term yields, let me just pull up the 30-year. This is the 30-year yield. We got as high as 5.15 back in May. The 30-year yields are now down at 44.566. So pretty dramatic. But again, the path of least resistance is probably lower on yields. We could easily see 30-year yields coming down to this prior recent low, right around here, testing around the 4.3, 4.4 level. That would be supportive of things like, we've talked about TLT. It's a ETF that holds longer term treasuries. This is a chart of that. This is a daily chart. We had, and just to zoom out a bit here, this is what it's been a horrible place to be for much of the past bunch of years. I mean, when 10-year yields were below 0.5% in 2020, that's as close as you get to a bubble in the bond market as a rampant bubble you might call in the stock market. That was a horrible time to be an owner of bonds because there was only one way for yields to go, and that was up and bond values down. What we've seen here is a painful consolidation, but one that probably is either going to be range bound or dripping higher. We think probably near term target on things like TLT, and this is not a recommendation. Happy to have an individual conversation with any folks that would like to call us. We think probably path of least resistance is to see TLT come back and test out this 100 level here. And if you look at a shorter term chart, a lot of the technicals, we just had a so-called golden cross, 50-day moving average came above the 200-day moving average. It's been quite a nice orderly rise in these bond values as interest rates have come down. So we're not hugely into long-term bond. It's still, even with the Fed's cutting campaign, we're still at a target rate today at 4 to 4.25 on short-term treasuries. That's almost certainly going to get lowered to 3.75 to 4%. That's the target range. But even still, if you look at the belly of the curve, 2, 3, 5, month treasuries, I'm sorry, year treasuries, those are down about 3.6, I think. So even though the Fed has started cutting, it's not like the T-bill and chill trade is over, because we do think there is good sound reasons to still have a bucket of very liquid, very safe things like treasury bills. We have about 22% in our tactical model right now. And that just simply represents for us optionality in the form of being able to convert that into other things, be it stocks or commodities or whatever, when conditions are more permissive and inviting.
So John, if somebody was doing T-bill and chill and really just rolling over really short-term T-bills, say like 30, 60-day T-bills, or I guess 4-week or 8-week T-bills, not personal financial advice, but would you encourage them to consider perhaps now maybe buying some 1-year, 2-year treasuries just to, if you're really liking that kind of 4% range, sure, why not lock it in for the next 2 years, as it looks like the shorter end of the curve is going to go downwards as the Fed continues to cut.
really depends on, and you've prefaced this. This is not financial advice because that's actually a real personal conversation based upon the objective of a client. We don't own we're not heavily invested in bonds. We own about 5% in 3 to 7 year treasuries, and that belly of the curve has actually rallied a bit because those yields have come off. We own about 7.5% long term. But if one is looking to use a bond portfolio to lock in like known income and maturities to for example pay for a kid's college education, tuition bills coming due, that's absolutely a valid thing to be thinking of. But I don't want to generalize. I don't think I could say in general because I do think that T-bills still are a fine place to be, and I'd rather have the short-term liquidity to be able to deploy into a stock market sell-off, for example, or a further pullback into precious metals or commodities. That I think is I would not encourage a wholesale kind of feeling like you got to go out on the curve. Some degree of that is certainly acceptable, but the belly of the curve, the 2, 3, 5 years, those aren't. I wouldn't call them cheap right now. They're not, dangerous, but it's not like this compelling slam the table. Go out and do that because you're fearful of short-term rates coming down. In fact, we could see the Fed's, cutting campaign, rather short-lived depending on how things play out. If we get a reignition of inflation here, I think they're going to have to go on pause, right? And we just can't forecast that. We'll have to see how that plays out.
Okay. Well, my short-term or shorthand guidance to folks would be if you're one of the many folks that have been asking, hey, I'm really heavily in T-bill and chill and I've been loving it, but I'm now concerned because it's going away. Shorthand answer I think from John is then talk to your advisor. There may be multiple different strategies that are worth considering here. There's no one-size-fits-all solution to that question. All right. Well, look, as we start to wrap up here, Mike, I'll come back to you briefly. I think you mentioned a couple of other sectors. I mean, obviously tech is doing amazing. I think you mentioned financials had been looking a little bit weak of late. As you look out at the different sectors that you guys are just watching, monitoring on a daily basis there at New Harbor, what ones are looking, particularly interesting to you, and what ones are maybe looking particularly worrisome?
So Adam, we're in the strongest sectors. That's what we attempt to do with the relative strength analysis that we use. The first thing we're looking at is what are the signals from the market? The market signals are tilting bullish here, but not decidedly so. So we're still 45% in equities, as I mentioned. We want to populate that with the strongest sectors. We got 15% of that as an international, a mix of broad international and emerging markets. Emerging markets have started to perk up quite a bit, by the way, particularly with China kicking in. So if you look at the iShares emerging market, ticker symbol EEM is 30% China. So it certainly has received some help on some of the latest developments in trade deal news there. But in terms of in general, the domestic sectors that we are in that are the strongest, it's utilities, technology, industrials, financials. Now, we're in financials, and I just admitted that it's weakening a little bit. So we have to use our discretion to decide when to cut something. Just because it starts to falter a little bit, we don't really know if that's a signal that says do something or give it a little more time, a little more rope. That's the hardest thing about being a personal investor or a professional. Financials is definitely the weakest out of our group. And we're going to wait and see what happens here. The ETF yesterday was a little bit below the 50-day moving average. Haven't looked at it today. But there's hedges in place on these things, on some of them. And they're only partial hedges. Covered calls are only partial hedges. Puts are more robust hedges, but they cost a lot of money. We prefer covered calls because they bring in money versus cost money.
Right.
So those are what we're in. Well, actually, and I forgot to mention that we just added the oil service stocks as a sector a couple weeks ago, and that has broken higher in the last week. So that's nice, and because that's been a laggard for a long time. Oil and energy has been a laggard. Healthcare has been a laggard. A few weeks ago, we started to see energy start to tick up and biotech/healthcare start to tick up. So we added oil service, but I have to also admit that healthcare and biotech is on our watch list, and we have not added it to our model yet. So if we keep staying bullish on our signals, then we'll we'll keep being in the strongest sectors. If the market rolls over, we'll cut the weakest sectors one by one. That's how it works with us. We're always looking for a shift. But technology out of that whole group that I just mentioned is the strongest, almost worryingly so. It's been
Mhm.
so relentless, but we're in an ETF in technology. So yeah, tech, industrials, utilities, oil service, and financials right now, with financials being the weakest.
Okay. And let me just ask you a what if. Um, Not saying that this is going to happen, but just let's say there is a reversal in tech. I know it seems so hard to consider right now because it's been the lead dog that has pulled the sled for so long now. But so much market value is now concentrated in it, right? You mentioned earlier that the top 10 companies in the S&P 500 now make up 40% of the interest. The vast majority of that market cap from those top 10 companies are in tech, and a lot of that's in the AI trade. So if something were to compromise that, what do you think the knock-on effect would be on the overall markets?
I don't, very bad. I don't really see any way that that would not be very bad for the market. There's no way for the market to do well if those were to come down. Again, I'm speculating here. I think we're going to get a squeeze higher, and it's probably going to continue to be concentrated in these names. It's eye-popping to see, Nvidia chart, Nvidia market cap 5 trillion. If these things come down hard, the whole market's going to come down. So it's more likely we get a squeeze higher, and maybe some of the laggards actually start to participate as well. Watch for the S&P equal weight. Like take a look at the ETF RSP, for instance, or the Russell 2000, ticker symbol IWM. Keep your eyes on if they start to break out of their ranges and decidedly move higher, then frankly everything's going higher, including those names you just mentioned. But it's kind of a worrying thing because I'm even listening to myself talk here. It's just like a bubble, right? I'm talking about a bubble. So you don't want to see the tech falter here because that would be bad.
Yeah, well, that's interesting. So, I mean, that's the huge debate. Is it in the bubble? Is it not? Um, Many big names, including Sam Altman himself there at OpenAI, have said of late, yeah, it's in a bubble. And I've even heard it said by folks in the space, it's in a bubble, but it's in a rational bubble. And I don't really know what a rational bubble is. To me, that sounds like mental gymnastics, just trying to justify it all. But I think what the spirit of that is just, hey, these are the way that these new technologies get put out there in the world is you have this massive capex race to be, the winners in the infrastructure of it, and then you realize you've overbuilt, and there's some cleansing, and then things recover from there. But you kind of have to do it this way, is sort of how they're saying it, right? True or not, these guys are pursuing it, at all hands on deck. And if it does prove to be a bubble, and Mike, you're right that there is some sort of, blow off top that sucks up everything into it. I mean, you just have to, in my opinion, to be an investor in this market, you have to have a plan for if and when the rose comes off the AI trade, and the potential collateral damage that could do, to your point, Mike, just given how big of a percent of the market it is. Who knows if it's going to happen? Who knows when? Could happen tomorrow, could happen 3 years from now. But I feel like if you're going to be along this market in any material way, you at least have to have a plan in place for what you're going to do if that thing starts reversing.
Absolutely. And I find that people have a very hard time psychologically selling on the way down. But that goes to having a plan. You might say, if we get a further melt up here, I'm going to start selling into that rally. That's a good plan. If we are wrong and we fall right from here and break technical levels, start to sell and take some stops. That's a plan. And we happen to be relatively semi-permanently underweighted equities versus the industry norm here at 45%. Well, that's because we know we're not perfect. And for the passive investors out there, because I know you probably have a lot of viewers that are passive investors, whether you're 60 or 80 or 100% in index funds passively, I just know that most people are not, A, they're not going to get out on the way down, and B, stock market valuations at these levels are not conducive with positive returns over the next decade, meaning you're likely going to see negative returns. And so, because of that fact, and because of the fact that people won't react on the way down, if you're passive, just dial down your exposure right here. get down to 30 or 40% stocks and stay with that the rest of your life. Well, or at least through this next market cycle, not necessarily the rest of your life, but index investing is really super long-term based, and it does work over a very long period of time. But not every time in history is equal. Near the crisis point of a fourth turning, at the highest objective valuations we've ever seen in the history of the United States, this is where you need to dial it down if you're passive, just so you can sit through it.
Yeah,
You know,
and I
sit
just want to
through
note for folks, there's a difference, use the word value. There's a difference between the word value and price. I'm not that worried objectively that the stock market's trading at the highest price that it's ever traded at. That's going to happen over the span of time. Prices will go up. You know, what I think we're all concerned about is valuations, is the multiple of that price versus the expected earnings, right? And those are very stretched to the upside here. And you guys have shown many times the John Hussman charts that show that when the market pulls that much of tomorrow's valuation into today by increasing multiples, it creates a return drought going forward. It just makes sense, right? If you're going to pull tomorrow's prosperity into today, well, you're going to have less prosperity tomorrow, right? So, you know, on average, you could have a very flat stretch of the market ahead of you, perhaps even a lost decade, as Hussman's charts are currently forecasting. Now, again, highly unlikely if that manifests that it's just going to be a flat market for the next decade. It means it's probably going to be, you know, up and down, a lot of volatility. And so, to your point, Mike, if you're a passive investor, you know, A, you're not going to make that much over that lost decade. And B, if your emotions get the worst of you, you may end up getting, you know, booted out of the market during some of those downdrafts and actually losing, right, money, having negative returns. Now, a good active investor can actually make a lot of money in that type of market, right? And you and many other people on this channel have recently, you know, who've appeared recently, have talked about that, hey, this may really be becoming the era where the pendulum swings back to active investing. And we'll see if that's the case. But I think your warning's an important one, Mike, kind of concurrent with what I was saying with T-bill and chill. You know, if you've been enjoying the past couple of years of getting paid to sit in safety in T-bills, and then whatever else you're long has done pretty well over the past 3 years, right? Looks like we're going to have our third back-to-back-to-back year of 20% or close to 20% returns in the S&P. I know what you're saying, Mike, is, hey, don't expect that to be the norm going forward. Highly unlikely to be that, right? You're shaking your head no as I'm saying this. All right, John, I'll hand it back to you and let you wrap up here. You know, anything else you want to say that maybe I haven't thought to ask you about? And also, too, if you could just do, you know, the general, like, you guys are in the business of talking to real people to help them grow, but most importantly, protect their wealth because they have lives to live.
Yep.
And so, you know, in your interactions that you're having right now, you know, what are you hearing from folks? What are they most nervous about? What counsel do you find yourself offering most to people right now, given the current market environment?
Yeah, thank you, Adam. And just to put a layperson's spin on what Mike talked about, have a plan to sell. One thing that I really want to encourage folks to just embrace is the idea of there is going to be regret. You're going to have regret no matter what you do. Perfection is not a possible thing in this thing we call investing. And the name of the game here is being okay with regret. And hopefully the form of regret that is the gentle kind, not the big kind, like selling out too early in a very toppy, and to put a point on it, Adam, not only are valuations stretched, they are categorically at all-time highs on the metrics that are most reliable with future predictive returns. That is a black and white categorical statement we can make without anybody's opinion affecting that statement. It's reality. Okay, so being okay with, you know, selling down from 80 to 40 or 30% and it not being the absolute high, that's okay. The worst sin and the worst regret that one may have to deal with is not doing that and having a massive reset in their financial security, one that literally may be forcing decisions like, hey, I thought I was going to retire 2 years from now. Now I got to work another 7 or whatever. These are the things that are a consequence when you overlay a real life with, you know, a financial portfolio and real life goals. So absolutely bring this back to your own situation. This time of year, let me just, in this environment, we are having more conversations with people that their job situation is less certain. We're not seeing massive layoffs, but we're seeing enough that it's becoming more of a concern, if not
Yeah,
outright
I'll note
layoffs.
this week we've seen many multi-thousand layoffs from
Yep.
some of America's larger employers.
Yep, layoffs or just the concern about layoffs. So if you're worried about your job security, even though you haven't been notified, this is a great time to take a step back and look at your plan, look at your investment plan, because if you have a situation where there is a layoff, there is a totally different game plan for how do you provide the paycheck that you will no longer be getting for whatever transitional or permanent period that might entail. We are entering the last 2 months of the year. It's always a good time to think about tax-related moves. Many folks may have very large gains in some stocks or positions, precious metals, for example, and they're worried about realizing gains, but they may also be forgetting the fact that they have other positions in their portfolio that are losses, and they can harvest those losses to offset those gains. For better, not worse, we don't have a lot of losses we can harvest this year in our client portfolios. We're very grateful for that. But still, if it comes time to sell and de-risk, the worst sin is letting gains evaporate than paying some capital gains taxes. So you want to be very, I think, objective about where we are and bringing it back to your own situation. And this is the time of year to really start to focus in on some of that stuff.
All right. Well, very well said, John. Thank you, gentlemen. So just in wrapping up real quick, first off, folks, if you enjoy these monthly check-ins with the guys from New Harbor and want us to continue doing them, please let us know by mentioning so in the comments below, but also by hitting that like button and clicking on the subscribe button below, as well as that little bell icon right next to it. A reminder too, if you did not attend the Thoughtful Money Fall Conference and really wish you had, you can still buy the replay over at thoughtfulmoney.com/conference. And if you'd like to buy your ticket for the spring online conference at a 0% inflation rate, meaning the same price that we've offered it for this year, the most recent conference we just did, then you can get that over at thoughtfulmoney.com/2026. To John's point there, I think a lot of what you guys, the takeaway from a lot of what you guys have said today is, hey, there's nuance out there. This is a time where a lot of people are sitting on some gains. Maybe they're sitting on some losses if things didn't go as well for them. The future looks, kind of uncertain here, for all the reasons that you mentioned about the floating risks out there, whether they're in the credit market, whether they're in the valuations. This is a really good time to check in with your personal financial advisor and, really make sure that you're entering 2026 having done all the key end of year things that you should do given your personal situation here in 2025, but also setting yourself up well for 2026 in a very hopefully intelligently risk managed way. So if you've got a good financial advisor who's doing all those things for you well, great, don't mess with success. But if you don't have one or you'd like a second opinion from one that is skilled in those topics, then consider talking to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to John and Mike themselves directly there at New Harbor Financial. So to set up one of those discussions, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service these firms offer to be as helpful to as many people as possible. John and Mike, great job as always, my friends. I'm looking forward to seeing you next week to do our regular, weekly market recaps, but very much appreciate these much more in-depth monthly deep dives and looking forward to doing a lot more with you in the future.
Thank you, Adam. Always fun. We'll see you next week.
Thanks for having us. So happy to have this opportunity. And thanks to all you viewers for watching. See you soon.
All right, boys. And everybody else, thanks so much for watching.
Gold is becoming more expensive. It is the dollar which is losing its purchasing power versus gold. The price has been steadily moving upward over the last 2 years. And it surges it breaks out, it surges 15%, it consolidates for another 3-4 months, breaks out, surges 15, 20%, consolidates for 3 or 4 months. This has happened 3 or 4 times now. And as most people know, it's been consolidated under 3,500 since about April or May. It's now broken out, and I think there's a rush of speculative interest because another 15%, if we keep the pattern going, takes us up to about $4,000 an ounce. I think the next move is, in this current move, is probably to 43 and a half, 44. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through.
Gold's rise isn't about it becoming more expensive. It's the dollar steadily losing value against it. For the past 2 years, gold has followed a pattern of breaking out, surging 15 to 20%, then consolidating for a few months before repeating the cycle. After holding under $3,500 since spring, it has now broken higher, and if the trend continues, the next leg could carry it toward $4,000 an ounce. Silver, meanwhile, looks set for a move toward $43 to $44 in the near term, and with expected rate cuts and yield curve control ahead, next year could be when it finally breaks through the long-standing $50 barrier. Craig Hemke is a longtime precious metals analyst and founder of the website TF Metals Report. He recalls that back in 2011, silver's sharp run from $38 to $48 in just 4 weeks wasn't a bubble, but the result of a commercial short squeeze. Speculators were long while commercials were heavily short, and when shorts had to cover, prices exploded. If commercials pile on new shorts, silver will likely grind higher in a slow, stair-step move. But if they start covering without heavy speculative buying yet, that could trigger a breakout, drawing in new money and creating a powerful rally. Silver tends to sit quietly for long stretches, but once momentum builds, FOMO quickly takes hold. The current move may aim for $43 to $44 before pulling back, but next year, with rate cuts and yield curve control likely, it could be the time silver finally smashes through $50. If it does, tests that level as support, and holds above it, then the market could truly take off. If silver breaks above $50, the real stress will likely show in London's physical market, not comics. With supply deficits, limited float, and heavy reliance on paper ETF instead of real bullion, a surge in demand could expose shortages and trigger major volatility. That's when silver could truly get spicy. As we play Craig Hemp's video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
Crazy breakout camp just yet. I think it's an important time for people to be paying attention to what's going on internally with silver. In April of 2011, okay, so most people remember that, price went from 38 to 48 in about 4 weeks of that month, over the course of the month. And it was assumed, it was written up, and people look back, with revisionist history and make it sound like it was a big speculative bubble. What was actually going on, if you followed the Commitment of Traders report back then, was a commercial short squeeze. They had all these speculators that are long, all these commercials that are short, and they started having to cover shorts for, without going into all the details as to who was short and why and all that stuff. But you could just see it on the Commitment of Traders reports. And that's what took it from 38 to 48. I think, could we have a similar month now? Of course. But we want to be watching those Commitment of Traders reports because it'll tell you a lot. If the commercial side of that equation is aggressively adding new shorts this month, okay, well, we're just in that kind of stair-step phase, of 2 steps forward and 1 step back. But if we start seeing a lot of commercial short covering without a lot of new speculative money yet, and that's what drives us, well, then, when we get that breakout of, top of the cup, then you get this big rush of speculative money that just catapults you further. Because silver's a lot like, and I'm sure I've used this metaphor before, it's like Newton's law of inertia or motion or whatever it is. I took physics, but it was a long time ago. An object at rest remains at rest until a force is applied to it, right? Just sit there. My computer's right here, but if I push it, okay, all right. It'll remain at rest until a force. And that's kind of what silver's like. Silver just sit there, as we all know, and just do jack for a long period of time, even like not keeping up with gold because people are waiting. They're like, well, I'm not going to get involved in silver yet because it's just sitting there doing nothing. But then as it starts to get moving, then you get this kind of FOMO thing. Hey, we've seen this before. And so what will probably happen, I would not expect it to smash through the $48 to $50 all-time highs in the first try. That's generally not how it works. And so I wouldn't think we would get there this year. You go up, we could go to, I think the next move is, in this current move, is probably to 43 and a half, 44, given the channel that we've been tracking higher. Pull back, maybe under certain conditions, we make another run later this year. I think it's in next year. If I'm right about all this yield curve control, cutting of rates, all that jazz, I think next year is when you get to 50, or at least you finally break through. You go up, tap it, find resistance, finally break through. Everybody goes crazy, and then it pulls back, tests that old resistance level for support. And if it finds the support and you stay above 50, and then start making new highs after that, well then, holy Toledo, then we could have some fun. And this all the stuff we've talked about all these years, Elijah, about how much silver is there really in the world? The supply deficit over the last 4 years. How much free float is there in London? How many ounces are levered? How many times supporting the derivative markets? All that stuff. If we set off on this, break through 50 and everybody starts getting excited and the banks don't want to fool around with it anymore because they don't have it, they don't want to deliver theirs out or whatever, things could really get spicy next year. I saw that stuff too last week. There were 9,000, I can't remember, 9,900 or something COMEX September silver contracts that were open and standing for delivery when that contract went off the board. And then it gets delivered against, you got to be 100% margin long covered so that you can take delivery if that, you're long and somebody the short puts the silver to you. And, historically, that's a lot. But back in March and May, we were doing 18,000 contracts. Okay, so it's not like, oh, wow, it's 10,000 in September, the system. No, it's not. No, not yet, at least. Okay, but it is a not insignificant amount. If we've already delivered almost all of those, that's 50 million ounces. I don't know if it ever actually leaves the COMEX or if it's still just this, oh, this month I'll take delivery, next month you take delivery stuff. So we'll keep an eye on that. I don't think that's where the stress is. To me, after kind of getting excited about that 15 years ago, I don't think that it's the COMEX where you'll see delivery stress. It's more likely in London. I'll give you this. I mean, you've seen over the years, Elijah, and I'm sure everybody listening has seen this, where like Stan Druckenmiller or Ray Dalio or, whomever, some big hedge fund manager, they'll say, we want to own gold. And you're like, good. And then they buy the GLD, right? And you're like, well, what good is that? I mean, that gives you price exposure, but you don't really, you can't take delivery, Stan. You can't take delivery.
Craig Hemke explains that the dollar index is misleading, as it only compares the dollar to other weakening fiat currencies. While it appears stable, all major currencies are losing purchasing power together. Recently, talk of yield curve control has quickly gone mainstream, signaling that central banks may soon cap long-term rates to contain debt costs. The U.S. looks set to follow this path, echoing past strategies to manage high debt. If that happens, it would echo what the U.S. did after World War II, when debt-to-GDP ratios were similar. Back then, the Fed and Treasury worked together to hold rates down, effectively inflating away the debt with cheaper dollars in the future. We could see something similar soon, especially if Fed leadership changes. This would likely require massive new quantitative easing, with central banks buying and monetizing their own debt in a move resembling modern monetary theory. Such a shift would push real interest rates deep into negative territory, and that's extraordinarily bullish for gold and other precious metals as fiat currencies are steadily devalued.
The deception of the dollar index, because it just compares the US dollar versus all this other equally worthless fiat, right? And so the dollar over time, you pull up a 30-year price chart of the dollar index, and it's, it's 100 and it goes up to 120 and down to 80 and it just stays basically the same. Well, that's because all the other fiat currencies are devaluing at the same rate. But I said, expect more rate cuts than what people are thinking are coming. And furthermore, don't be surprised if by December, the December FOMC meeting, the Fed isn't openly talking about yield curve control. And I mean, I wrote that like on New Year's Eve last year. There were nobody talking about yield curve control. But now, all of a sudden, here in late August, early September, it's like, oh yeah, yield curve control is coming, like everybody was predicting this 8 months ago. Yield curve control is coming. Whether it's globally, if all these central banks have to do that to control the long end of their curve, right, and control their interest costs. But I think you're definitely being told and warned that it's coming here in the US. And I think that's all part of what's driving gold too, because that would be extremely bullish news for gold. You'd be holding real interest rates sharply negative. I mean, the US has done this before, which is why I wrote about it in my pod. I even put a link in there in that macrocast, because coming out of World War II, when we had similar debt to GDP ratios, that's what they did. They kind of combined the Fed and the Treasury together. They did yield curve control, essentially to pay off the debts of yesterday with the cheaper money of tomorrow, right? Get it under control, grow your way out of it, which is what Bessent keeps talking about now. Well, anyway, if you want to take the time, to connect the dots, I think they're telling you that's what's coming as soon as next year, once Powell gets replaced and everything else. And so if that's the case, they're going to be trying to cap the long end. It's going to involve a lot of new quantitative easing measures, central banks buying their own debt, monetizing, almost like a modern monetary theory move. Again, all of this is extraordinarily bullish for the precious metals in terms of devaluing the existing fiat currency.
Both gold and silver are flashing signals of major shifts ahead, fueled by monetary policy, debt dynamics, and the growing disconnect between paper markets and physical supply. If central banks resort to yield curve control and deeper monetary easing, precious metals could enter a new era of explosive gains, marking a turning point for investors who have been patiently watching these markets build momentum. Do you think central banks will be forced into yield curve control sooner rather than later? If silver finally breaks above $50, will physical shortages in London expose the true limits of supply? Leave a comment below with your opinions. We would be delighted to hear from you. Please remember to subscribe for more material, and give this video a thumbs up if you found it useful. We appreciate you joining us on this adventure.
The purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99%. The dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce. And that was from, 1856 or something. And it was... it was de facto, but then it became de jure with the Gold Act in 1900. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. That's so much like Germany between 1922 and 1923.
Although the dollar's decline began earlier, it has already lost about 99% of its purchasing power since it was separated from gold. Deutsche Bank has explicitly warned of a crisis of confidence in the US dollar, suggesting that shifts in global capital flows might overwhelm usual currency fundamentals, causing erratic moves. JP Morgan says the dollar's long bull run is ending, with an expected 10 to 20% medium-term decline against the euro and yen. They see this not as a collapse but as a gradual reset. By 2026, increased tariffs and a failing dollar might cause prices to rise, a scenario similar to Germany's inflation crisis in 1922 to 1923. The dollar has lost around 99% of its value, albeit the slide started earlier. The 1900 Gold Act established that $20.67 would purchase 1 ounce of gold until 1934. Now, in mid-2025, JP Morgan warns that U.S. tariffs, trade policy, and slowing growth could lead to stagflation. They lowered their U.S. GDP growth forecast for 2025 to 1.3%, from 2%, owing to tariff impacts. They also expect foreign demand for treasuries to decline, which weakens one pillar of dollar strength. The International Monetary Fund (IMF) has also flagged that recent U.S. tariffs could add inflationary pressures and warned of weakening domestic demand and slowing job growth. The Roaring Twenties and the 1929 crisis were both exacerbated by Hoover's tariffs and the Fed's credit expansion under Benjamin Strong. Now, the risk is much higher and might destroy the currency due to Trump's tariffs at the height of a huge debt bubble. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, basically, what you've said it all. I mean, the purchasing power of the dollar has fallen 99%. Those are the numbers you're saying. 99% since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep.
And President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. Yeah, I mean, basically, no. We used to have a phrase, which I don't hear nowadays, about kicking a can down the road. People, I think, sort of think, whoops, I don't think it's, they start talking about a reset and, all this sort of rubbish. I mean, the fact of the matter is that the Fed has got no control over the situation. And it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. This is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War.
Right.
Hayek actually put this very, very well in his Road to Serfdom. He sort of had a bit where everybody starts saying, we need a strong leader, to get us out of this mess, because they'd had enough of the weak politicians who screwed it up. We need a strong leader. And what did they get? They got Hitler.
Germany experienced 3 stages following World War I. The first, from 1918 to 1920, saw the mark lose roughly 80% of its value, akin to the inflation that followed the COVID-19 pandemic. The second, from 1920 to 1921, saw a brief improvement as the mark strengthened, business resumed, and optimism returned. And the third, from late 1921 to 1923, concerning parallels can be seen in the U.S. today. Officials are publicly pushing the dollar lower, markets have soared, and bond yields are still high. Only short-term T-bills are in demand, as foreign investors are shunning long-term treasuries. The dollar may plummet if bond yields increase while the Fed lowers interest rates. When tariffs are added, we may witness a crumbling dollar and skyrocketing prices by 2026, akin to Germany's hyperinflation. Since exporters benefited, politicians and business groups at the time even favored a weak mark. Similar to this, current policies run the risk of devaluing the dollar's purchasing power even while they may benefit certain groups. Let's dive into the interview.
Yeah, we're not quite there yet. I mean, you mentioning the, Adam Ferguson's book, When Money Dies, and all the rest of it actually hits the nail on the head. Because I put out a note, I think it was a few days ago, which looked very, very carefully at what happened in Germany between 1918, which was the end of the First World War, and 1923. And there were three phases. The first one was between 1918 and 1920, when the purchasing power of the Reichsmark fell about 80%, something like that. So, this was a nasty situation. Now, this is actually quite like what happened following the COVID shutdowns.
Right.
And then we had this inflation, which meant that the purchasing power of the dollar actually fell. Not as much as 80%, admittedly, but it fell quite sharply. And then what happened in Germany from around about February 1920 to December 1921 was suddenly things improved. And the Reichsmark actually went up against the dollar, which, remember, was on a gold standard, on a proper gold standard. You could exchange your dollars for gold at 20.67 to the ounce. So the Reichsmark was strong. Businesses were recovering, if you like, from the shock, the post-war shock. There was a certain amount of tourism going on. I mean, things were really humming. The stock market tripled. Everybody thought, this is absolutely wonderful. We've got over this, etc., etc. But then there was a crash. I think the stock market lost something like 25% in the December of 2021.
1921.
Sorry, between 1921, end of 21, in other words, through 22 and 23, what happened was that the purchasing power of the Reichsmark began to collapse. And the collapse was total. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Now, on top of that, what do the foreigners do? Well, everybody, including the large institutions, stand back and they don't buy treasury bonds. Certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. Because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it.
The warning signs are obvious, and preparation is crucial, regardless of whether the dollar experiences a similar fate. Will authorities intervene before it's too late? Or do you believe the United States is on the verge of a disaster akin to Germany's collapse in the 1920s? Should the dollar really start to depreciate by 2026, how should investors position themselves? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you.
Like, I personally have a price target on gold up near 15,000. Not tomorrow, not this year, but in the fullness of time over the course of this bull market. $15,000 price projection is simply an average of the previous two bull markets, the one in 1970 through 1980, and then you call it 1999, 2000 through 2011. If you average the returns in gold through those two bull markets, that gives you about a $15,000 target. We're susceptible to a sharp pullback, that is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap. Higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50.
The long-term outlook for precious metals suggests significant upside, with gold potentially reaching $15,000 over the course of this bull market based on the average gains of the previous two major cycles. While short-term pullbacks remain possible, the broader trend points higher, with silver showing strong technical support that could drive it toward the $44 to $50 range, and possibly even $75 if momentum continues. Steve Penny, a respected precious metals analyst, trader, and newsletter writer, explains that after gold first touched $3,500 in April, the forecast was for prices to move sideways with a slight upward bias for several months, allowing silver and mining stocks to catch up. That's largely what played out, with gold consolidating for about 6 months before breaking higher, while silver and miners began showing strong momentum. The key lesson here is strategy. Knowing when to buy is straightforward, but investors must also plan their exits. Bull markets are volatile, with sharp swings both ways, so deciding whether to hold through volatility, take profits, or actively trade is critical. Looking ahead, Steve Penny mentions that the dollar sits at an important support level after months of decline, which has boosted precious metals. However, an unexpected bounce in the dollar could trigger a sharp pullback in gold and silver, especially since gold is at its most overbought level on long-term charts since 1980. While the long-term outlook remains extremely bullish, with targets of $15,000 gold and $200 plus silver, caution is advised in the short term. The strategy suggested is to trim speculative mining stock positions as silver approaches $50, then keep cash ready to buy back on pullbacks. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, so please leave a comment below and give us a thumbs up if you found the article interesting.
After the April peak, where we first tapped $3,500 in gold, my forecast, I believe we talked about this. I know it's been a little bit since we spoke, but I was saying, hey, I think it's very likely that we just kind of grind sideways in gold for a few months to maybe a quarter or two. And, that's not what people want to hear when it's just ripping straight up and stocks are going down. We want to hear to the move. Well, that was back in April. Well, April, May, June, July, August, now we're into September. So 6 months almost of just kind of sideways. And now we're finally breaking out. But my forecast was that gold would just kind of trend sideways to maybe with an upward bias. And that would allow silver and the mining stocks to play rapid catch up. And we're beginning to see that. That's finally coming to fruition. Now, as I share a couple of charts here, I just want a key takeaway from this interview is for people to think about your strategy. Knowing when to buy is fairly easy. It's when everyone hates it. But, everyone needs to have a personalized exit strategy of, are you going to just sit through the wild volatility? Are you going to take profits? Are you going to trade around your mining stocks? These are important things to think about, especially as things begin to move, because these bull markets are incredibly volatile. And we're seeing the volatility to the upside now. And as surely as night follows day, there will be volatility to the downside as well. So the question is, do you want to sit through that? And here's kind of a basic roadmap I have. Now, I think any roadmap should be taken with a grain of salt because no one knows the future, right? But one thing charts help us to do is, make if-then statements and have a roadmap. And then we adapt as new information comes in. And when I look here at this long-term chart for the US dollar, what I see since 2008 is a gently rising uptrend. And where are we at right now? We're right at the lower rail of that uptrend channel. And of course, the dollar has been declining for several months now, for a while, and that's been a tailwind to hard assets, namely precious metals, silver and gold. Well, I think what a lot of people maybe aren't expecting is for a pop in the dollar, an unexpected pop in the dollar, and that could result in a sharp pullback in the precious metals. I mean, we've come really far, really fast. Gold on the monthly chart is now the most overbought it's been on the RSI since 1980. It's the second highest overbought condition ever. That doesn't mean it can't go higher. And I'm not saying that. You're talking to someone who's probably as bullish as you can possibly be. I just told you I think gold's going to 15,000. I think that's fairly conservative. Silver, $200-$300 or more. But at the same time, over the short term here, I think caution is warranted. So I'm certainly wouldn't be chasing, gold and silver here. But you can see on this dollar chart, we followed the roadmap so far. I drew this potential path a while ago, and we've declined. Well, now here we're sitting right at the lower rail of the support. I can see some kind of exogenous shock causing a pop in the dollar. That just intuitive reactionary flight to safety, perceived safety, because you and I both know, the dollar should not, be a safe haven, but that's the knee-jerk reaction when panics happen. So I think that could happen. That could see a pullback in precious metals, and how you want to trade around that is obviously for you to decide. But for me personally, I plan to take a little bit off the table in my speculative mining stock positions as we move up towards 50, if that does indeed happen in silver, and then have cash available to scale back in on any kind of pullback.
Steve Penny, in an interview with Liberty and Finance, points out that in silver bull markets, most of the gains often come in a short burst near the end of the cycle. While silver could face pullbacks, the technical setup suggests prices are headed toward the $1.44. That may be a good point for traders to take some profits in paper positions like mining stocks, while physical silver remains a long-term insurance policy. For gold, prices are already in a zone where trimming speculative exposure could make sense, as miners like GDX show extreme overbought signals despite gold being far higher than in past cycles. At the macro level, Steve Penny thinks that the Fed is under immense pressure, as soaring debt makes interest payments unsustainable. Historically, governments always choose to debase their currency rather than default, and the U.S. is no exception. With markets expecting a rate cut soon, the real test will be the long end of the yield curve. If long-term rates rise even as the Fed cuts, it would show a loss of control, likely forcing extreme measures such as yield curve control. That scenario would accelerate the bull market in precious metals, fueling even stronger gains ahead. Let's get the interview started now.
90% of the move in silver bull markets happens in the last 10% of the time. And, that may not be exactly numerically correct, but conceptually, I believe it is, where you get the biggest moves in the last part, of a bull market. I'm not saying the bull market is over, but my point is, right now, we're susceptible to a sharp pullback. That is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap for, hitting higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50. So the short answer is I think we're probably headed somewhere between 44 and 50, maybe a little bit higher. But I think that could present an opportunity to take just a little bit off the table in speculative positions. Now, I just want to give a caveat. When I say that, I'm talking about paper positions. I'm not talking about going to sell your physical. To me, I view physical as a generational insurance policy against these out-of-control central planners. I don't trade that. I'm talking about if you're into mining stocks, if you're into paper trading vehicles, that could be a time to take a little bit off the table between 44 and 50 in silver. That's kind of what I'm looking to do myself.
And as for gold here, do you have any price targets of where maybe taking at least some paper profits off the table would be a good option?
Yeah, so I think in gold, we're probably already in that territory. So one of the cool things probably isn't the best way to put it, but one thing about when you're in new all-time high territory, a lot of people think that's bearish. Oh, you're overbought and it's all-time highs. Well, that's actually can be bullish as there's now no overhead resistance. But you can use kind of like price projections and measured move targets. And my measured move target for this year was about 3,500. So we've already exceeded that. So I think this could be right around in here between 3,500 and 4,000. If you're in big gold miners, like you can look at a chart of GDX and that would probably be a good one to pull up. But like on the chart for GDX, we're getting extreme overbought and we're closing in within, spitting distance of the all-time high resistance at GDX. Now you can make a case, last time GDX was at this level, gold was $1,900 back in 2011. And here we are, $3,600 gold, and GDX is just getting back to that same level. So you can make a case that it slices right through it like a hot knife through butter. However, just from a purely technical perspective, we're getting overbought here, right now in the big gold miners. And before I moved on, I did want to just share this chart for GDX. This is that long-term monthly chart. And you can see, look at this RSI right here on the top right of the screen. I'm hovering over it for anyone watching on YouTube. The monthly RSI is at 80. That's the highest ever on record. Not like an immediate sell signal, but it's a caution signal. Kind of be aware of that. And as a general rule, when you get extreme overbought against clear, obvious resistance, typically you don't punch straight through it. So big gold miners, that just reinforces the case to maybe take a little bit off the table before, I think we're ultimately going much higher. So it's up to, individuals if they want to just sit through that volatility or, kind of use volatility to your advantage. I look at like the drama going on between the Fed and the president as kind of theatrics and a sideshow. It just highlights what you and I have known for a very long time, and that's Tina. There is no alternative. The Fed is between a rock and a hard place where they have to choose between sacrificing the dollar or sacrificing the economy. And history is replete with examples where central planners, those in power, always choose to debase the currency as opposed to default honestly. The federal government's in a situation, and by the way, this is all governments around the world, every single one, 100% of them, are in a situation where the debt is mathematically unrepayable. So they can choose to either debase the currency or, default, honestly, and they never choose to default. So they're going to debase the currency, and that is just explanation for why there's such pressure on the Fed to lower interest rates and, make more easy money to try and kick the can down the road. Because the biggest variable, we're heading to a point, and this is something I think everyone should understand, we're heading to a point where 100% of our tax dollars, 100% go to just service interest on the debt. That's the trajectory we're on. And the biggest variable in that equation of how to kick the can down the road is lowering interest rates. So, no one wants this, currency crisis to happen on their watch. So how do you kick the can? Lower interest rates. And that explains why there's such pressure on the Fed. And I will throw something out there. The futures markets are pricing in like a 90% probability that the Fed will cut rates on September 17th, just a couple weeks from now. The thing to watch is, and I'm not predicting this, but it's something to watch, is the long end of the curve. Watch the 10-year and the 30-year and see if, as the Fed cuts rates, if rates actually go up, that would be an early warning sign that perhaps the Fed is losing control. If they're cutting rates and then the long end of the curve, interest rates rise, that would indicate they're losing control, and that would indicate that they're going to need to apply even more dramatic measures like yield curve control, which when that happens is just going to be like pouring gasoline on the bull market in precious metals.
Gold and silver remain in powerful long-term bull markets, with potential for historic gains driven by currency debasement, debt pressures, and shifting global demand. While short-term volatility and pullbacks are inevitable, the broader outlook strongly favors higher prices, making precious metals both a strategic investment and a form of financial insurance. Do you think the Fed will be forced into yield curve control sooner rather than later? At what price level would you personally consider taking profits on silver or gold? We'd love to hear your opinions, so please leave them in the space provided below. If this video was useful to you, please give it a thumbs up and remember to subscribe for more. Thank you for being a part of our journey.